What's up everybody, Genix Dividend Investor here. In this video I'll explain why it becomes almost inevitable that a company that lasts will end up paying dividends. I'll also tell you about a guy who recently inherited $1.2 million and how he blew it all betting, rather than investing, in the stock market. Finally, I'll end things with a heart-wrenching story that will really reinforce why I love dividends so much. And to ensure that we're all on the same page, I'll first start by saying that a dividend is simply a payment made by a company to its shareholders, usually drawn from its profits. Think of it as the company sharing a slice of its earnings with you, like getting a bonus for holding onto your shares. Dividends aren't just about handing out cash, they also serve as a messaging mechanism for a company's management team. Like when a company pays regular dividends, it's also communicating that they're stable, mature, and they're confident about their future. Dividends tend to be in large, established companies, and the larger the company, the higher the likelihood that they'll pay dividends. For example, take a look at the spreadsheet I put together which helps make that point. It's a list of dividend-paying companies in the SP 500 that I manually created a couple months ago. What's interesting is that 84% of the Fortune 100 pays dividends, as compared to 83% of the Fortune 200, 83% of the Fortune 300, 82% of the Fortune 400, and 80.1% of the Fortune 500. So clearly dividends are valued and important to the strongest companies in the world, and anyone who says dividends don't matter probably hasn't studied them enough to fully comprehend what they're about. And to understand why companies eventually pay dividends, let's go back in time a bit. Specifically to the 16th century, when spices like pepper and cinnamon and cloves and such were desired in Asia and Europe due to their flavor and preservative qualities and for medicinal purposes. The demand for these spices drove to the creation of the Dutch East India Company, which began as a government-sanctioned merger of several competing Dutch trading companies aimed at unifying efforts to dominate the Asian spice trade. The Dutch East India Company decided it needed to raise money to help their business, and so they became the world's first publicly traded company by issuing shares to the public. They paid dividends to their shareholders as a way to distribute a portion of their profits generated from its highly profitable, but risky, trading ventures in Asia. Their dividends served several important purposes. Number one was attracting investment. By offering a share of the profits, the Dutch trading company provided a tangible return on investment, which helped attract a broad base of investors. At a time when long-distance trade was fraught with uncertainty, a promise of periodic cash returns made investing in the company more appealing. Number two was for rewarding shareholders. Dividends were a way to compensate investors for the risks they took in funding expensive and perilous voyages to Asia. This not only built trust, but also helped secure further capital for future expeditions. Number three was to signal financial health. Regular dividend payments acted as a signal that the company was profitable and well managed, thereby enhancing its reputation and credibility in the early financial markets. So the Dutch East India Company is credited as the first public company to pay dividends because it pioneered the practice of sharing profits with its investors. This approach not only rewarded those who took the risk of investing in long and uncertain trade routes, but also helped establish a model for corporate finance that continues to influence companies all the way to the present. Investors these days value dividends for those reasons, plus others, like due to the bird in the hand concept, where a bird in the hand is worth two in the bush. In the context of investing, this means that many investors prefer receiving a known, steady cash dividend today, rather than waiting for uncertain future stock price increases that may never materialize. Plus, the reliability of receiving dividends acts as a safety net, reducing overall investment risk and providing a consistent income stream, even when market conditions are volatile. Now, while dividends are a direct way companies return cash to shareholders, an indirect way worth mentioning are buybacks, and I'll circle back to them in a moment. Okay, and these days there are other additional reasons companies pay dividends beyond the ones I mentioned about the Dutch East India Company. Like now, companies can broaden their appeal to dividend income-focused investors, both in retirement and not, as well as to large pension funds. And with all that behind us, now let's understand how a company's life cycle plays a crucial role in the potential dividend-paying process. So companies typically go through several stages, each with distinct characteristics and financial priorities. The first stage is the startup or development stage. This is when a company is founded, often characterized by innovation, experimentation, and the search for a viable business model. High capital expenditure is common in this phase as a company invests in research and development, product creation, and market testing. Cash outflows usually exceed revenues, and the focus is on growth rather than profitability, so dividends aren't in the picture. Money often comes from founders' capital, angel investors, or perhaps venture capital. Companies in this stage hope to enter the growth stage, which is next. This is when a company begins to experience revenue and customer base expansion, hopefully quickly. Market acceptance is growing, and the business model starts to prove its viability. Earnings are typically reinvested to scale operations, expand market reach, and enhance product offerings. Although the company may start to generate profits, little to no cash is returned to shareholders because the emphasis is on capturing market share and driving growth. Funding may come from reinvested earnings, additional rounds of private funding, or perhaps public offerings if the company goes public, which is the next stage successful companies often go through. But dividends usually still aren't being paid at this relatively early juncture, especially as the company is pressing the accelerator on growth with its funding. After being in this stage for a while, a company eventually becomes known and ultimately enters a maturity stage. This is when growth rates aren't quite as high as they were initially, as the company reaches a larger market share and the business becomes more stable. Their brand is established and operational efficiencies improve. With more predictable cash flows and reduced need for aggressive reinvestment, perhaps as obvious growth opportunities diminish, the company can start focusing on returning value to shareholders. This may come in the form of early or modest dividend payments and/or share buybacks, alongside continued strategic investments. Earnings, cash reserves, and occasionally debt are used to fuel strategic initiatives while also rewarding investors. Now, some people mistakenly think that it's always smarter to invest rather than return cash to shareholders, but Buffett himself has said that doesn't make sense. If the business doesn't see viable ways to generate growth, and that happens all the time with companies, then it's better to return that cash to shareholders. The next stage is when growth slows even more and the market is saturated by competing goods and services. The company's focus shifts from expansion to maintaining market position as well as optimizing their operations. This is when a company may transition from being a dividend growth stock to being more of a dividend income stock. Dividend yield might inch up, while dividend growth trends lower. Companies in this stage tend to be more defensive and have more reliable payouts, and are companies that prioritize their dividends and maybe buybacks. So let's dive into buybacks. And for those that are new to them, what often happens is that a company uses some of their cash to buy their own shares and then retire them so that they no longer exist. That means their number of shares outstanding gets reduced, which generally increases earnings per share and potentially contributes to raising the stock price over time. This usually benefits shareholders by making each share they hold represent a larger portion of the company's earnings and assets. Some people prefer buybacks over dividends, but buybacks can have their issues to be aware of. Like, sometimes companies buy back shares when prices are high as opposed to when they're on sale, which isn't ideal. And history is littered with companies who wasted billions on buybacks while their core business deteriorated, leading to underperformance and sometimes bankruptcy. For example, between 2005 and 2010, Sears spent $6 billion on stock buybacks but then filed for bankruptcy in 2018. GM spent $20 billion on stock buybacks between 1986 and 2002, and then faced a massive financial crisis in 2008, worsened by a declining auto market and high legacy costs, and filed for bankruptcy in 2009 and required a government bailout to survive. Other companies which wasted money on buybacks only to ultimately flounder include Radio Shack, Bed Bath & Beyond, Toys R Us, and a slew of others. So while prudent buybacks can make sense, at least with dividends the shareholders are getting tangible benefits in the form of pure cash. That being said, there has been a trend of more focus on buybacks than dividends for decades now, as that's seen as a better way to drive up stock prices, and many executives' big bonus packages are tied to stocks hitting certain prices. And some companies do a little bit of both. However, while buybacks are an attractive option for many companies, they don't provide the same regular income stream that dividends do, which is why many income-focused investors still prefer dividends. And don't make the mistake thinking that dividend stocks can't outperform the market. I mean, take a look at AbbVie, Nvidia, Microsoft, and a bunch of others. Now, a disclaimer I gotta state is that dividends aren't guaranteed, and just because a company pays a dividend doesn't mean that company can't go bankrupt. And even if it's paid a dividend for a long time doesn't mean the stock or company is doing great. For example, Pepsi, a company I own, has paid a dividend for over 50 consecutive years, making it part of the Dividend King Club. But its stock price has done very poorly the last 5 years. However, even with that being the case, it still has been a great long-term investment for me. And speaking of Pepsi, this morning I saw a press release of their latest earnings, and they announced a 5% dividend hike. I recently ran a poll on my Twitter X account asking my followers to guess how much Pepsi would raise their dividend by this year, and the majority of voters correctly guessed that Pepsi would raise it between 3 and 6%. Now, beyond the 5% dividend hike they announced, they also said, total cash returns to shareholders of approximately $8.6 billion, comprised of dividends of $7.6 billion, and share repurchases of $1 billion, end quote. Think about how important dividends are to Pepsi's management team to return over $7 billion of cash to their owners this year. Talk about amazing. And another amazing thing is seeing my dividend history of Pepsi payouts since I started a new version of my dividend spreadsheet in January of 2020. So my first quarterly Pepsi dividend payout 5 years ago was for $702. Pepsi pays 4 times a year, but it isn't always 3 months apart, and in this case Pepsi's next payout came in March for $717, increasing a bit because my drip bought more shares. Then in June of 2020 they did their annual hike and my quarterly payout increased to $774. Then my drip bought a bit more shares and the September 2020 payout was for $780. Then in Jan of 2021 my drip took me to $786. And that's when I retired on my dividend portfolio, as it was finally generating more in divvies than my family's expenses, so I turned off all my drips and started using all my dividends for expenses. So in March of 2021, I again got paid $786 from Pepsi. Then they did their hike in June, and my payout increased to $825. It stayed at that level until the hike in 2022, taking me to $883 a payout. Then it stayed there until the 2023 hike, taking me to $971 a quarter. They kept paying me that quarterly amount until their 2024 hike, when my Pepsi quarterly dividend payout was raised to $1,040. And they paid me that amount for a few quarters until today's 5% hike announcement, and my forecasting calculator in my spreadsheet shows me that my payout in June of this year should be $1,092. So think about that. 5 years ago I was getting $702 a quarter, and now I'll be getting $1,092 a quarter. I didn't put any more of my cash into it other than for the first few years where my drip was buying more shares. But I still ended up with getting paid 56% more per quarter in just 5 years' time. That's the power of compounding and a company that has raised their dividend each year. Now, I originally got in Pepsi a lot longer than 5 years ago, and you can watch a video I did called "The Time I Sold All My Stocks" to understand what happened. Anyway, I posted about Pepsi's hike on my YouTube channel under a section that used to be called comments but is now called posts, and I had an exchange with a user named Dividend Collector. He said he loved the hike, but unfortunately they weren't able to cover the dividends for the full year with their free cash flow. I responded saying, "I'm not worried at this point. The robust quarterly performance and PepsiCo's historical track record suggests to me that the dividend remains sustainable in the near term. Long term, I'll keep monitoring it. If the operating cash flow persists or worsens, it would merit closer examination. As long as PepsiCo's underlying business remains strong and it manages its working capital efficiently, the dividend should remain sustainable. I still have confidence in their management team and don't think they'll jeopardize things by foolishly increasing their dividend by that much without confidence that they could handle it. But time will tell." So that's something you'd need to dig into more to figure out if you're comfortable with what Pepsi is doing and where you think they're going. And just because I continue to hold it doesn't mean you should. Anyway, in my videos in the past, I've made the point that companies eventually pay dividends if they last, and I've gotten comments from people who said that some companies will never pay them, like Facebook, which is now called Meta today. And in that case I was right, because last year they started paying a dividend. I've also had people tell me that Google will never pay a dividend, and yet again last year they started one. And I'm sure some people right now are thinking Amazon will never pay one, though I bet you they will someday. Of course, the elephant in the room counterexample to my premise is Berkshire. And Berkshire's been public since the 1950s to 60s, but they still aren't paying a dividend. So are they just an edge case example, or what's going on? Well, if you watched my video called "Why Berkshire Hathaway Will Eventually Pay Dividends," you would have seen video clips where Warren says that the time will come someday when Berkshire will pay out a dividend. But right now, with Buffett at the helm, they feel they can continue to create more than $1 of value for each dollar Berkshire invests, rather than pay out as a dividend. But yes, even Berkshire will pay a dividend in the future. Okay, that was a lengthy sidebar, so let's wrap things up a bit and talk about the final stage in a company's life cycle that they inevitably go through, and that's the decline phase. Eventually, all companies face declining revenues and market challenges due to increased competition, technological shifts, market saturation, or something. So yes, that means every company will go bye-bye at some point. Sometimes companies can pivot and get back to growing things, but sometimes they just slowly wither on the vine until someone buys them out, or someone drives them out, or until they merge or something like that. That's part of the reason why you need to stay on top of your investments, because you don't want to be left holding the bag as your company falls apart. And that's another reason why broad market ETFs are usually easier and better for most investors to focus on. You basically don't need to worry about bankruptcies of tickers being held in an ETF, because the impact should be relatively small. So while some companies might flourish for centuries, they too will one day die out. And to save itself, a company will restructure, and/or cost cut, and/or seek financing, and/or a slew of other options that will enable them to strategically pivot. Anyway, I've made lots of generalizations in this video to simplify things, and sometimes outlier companies can exist that will buck the norms. Some companies might not go public or whatever, but for large companies that make it in the US, a dividend is most likely in their future if they can last. So should dividend stocks be a part of your portfolio? Well, that depends. When you're building a diversified investment portfolio, some dividend stocks can serve nicely in times of market volatility. Regular income from dividends can help smooth out returns and reduce the impact of stock price fluctuations. Plus, the combination of reinvested dividend income and capital appreciation can lead to impressive total returns over the long term. For many investors, especially those planning for retirement, dividends provide a sense of security and predictability that pure growth stocks simply can't match. But hey, great quality growth stocks often have stock appreciation that most dividend stocks won't see. So don't neglect either one. And if you do go down the dividend route, then don't forget about taxes. In some cases, dividend income can be taxed at a lower rate than ordinary income, making it an attractive option from a tax perspective. Of course, tax laws vary by country and can change over time, so it's important to stay informed about the current tax treatment of dividend income and ultimately how it might impact you. One little known fact is that if you don't have any other source of income and you only have qualified dividends in a taxable account, then as a married couple filing jointly, you can make $123,000 a year in qualified divvies and owe $0 in federal income taxes. Compare that to a job where you'd owe almost $11,000 in federal income taxes. Of course, probably best of all is holding your divvy stocks in a Roth so that you basically don't have to worry about taxes while your drip helps the compounding magic to happen without worrying about the drag of taxes that you might see in a taxable account. Okay, let's move on, and now I'm going to tell you about a guy named Smart Money who recently posted on Wall Street Bets that he inherited $1.2 million from his grandpa and then bet it all on DJT call options. Note, I'm not even sure if this is real, but enough people have done stupid stuff like this on Wall Street Bets that even if it's fake, there's still a lesson to be learned. Basically, he bet $1.2 million that DJT stock would be over $47.63 by March 31st of this year in order for him to make out. He was thinking that Trump's stock would get a lot of people, companies, and even countries all FOMOing into it, driving the price up. He showed that he bought 1,654 call option contracts of DJT stock, and one contract represents 100 shares of the underlying stock, which means he'd have control over 165,400 shares. 165K at an average cost per contract of $763 means he invested $1.2 million, and the break-even price is a bit over $47. Break-even is strike price, which is $40, plus premium paid, which is $7.63, which totals $47.63, and the slight discrepancy of the DJT break-even price listed here of $47.65 is probably due to rounding or small fees or something. So Smart Money posted updates on Reddit as his DJT stock fell, like the screenshot from a week ago where DJT was at $29 and he was down $1 million on it. Along the way, people on Reddit were telling him to cut his losses and get out of it, and at least walk away with some free money since he inherited all of it, but the guy kept thinking it could come back. Now, I'm not sure if this guy is legit or not, and a lot of people on Reddit were trying to figure that out by analyzing his history and the video and screenshots and options data out there, but no one had definitive proof if he was actually that crazy. I'm not sure, but what I do know is that most people who try to get rich quickly usually end up getting poor quickly. The fact is that every investment has some risk with it, and sometimes you will lose even by doing everything right, though in my opinion this guy wasn't doing anything right, even if he ends up doing well. I mean, sometimes even solid companies can be cooking their books, and doing illegal stuff like that can sink a Titanic of a company. But while you can't control a company doing shady stuff, you can control where you allocate your capital, and you can also control how much risk you take. If you do want to gamble a bit on something, then limit things to under 5% of your portfolio or whatever, so that you don't get wiped out. Don't put all your investing eggs in one basket and try to control your downside loss. Diversify your portfolio as the numbers get bigger. And now I'll switch gears one last time and tell you a heart-wrenching story that will really reinforce why I love dividends so much. So my wife works at an hourly job that she absolutely loves, mostly because she chit-chats with coworkers and customers all day long. She works less than 40 hours a week and literally has said that she wants to work there even if we won $1 billion lottery. Anyway, she was talking to an older female customer this week who was complaining about how things were getting too expensive for her and that the money she had in the bank, combined with her Social Security, was trending down. She said that she saw the writing on the wall for when her money would run out, and she didn't want to be alive to see that happen. Her husband had been the breadwinner in the family, and after he died, she started living on what they had in the bank along with Social Security. My wife tried to raise her spirits, but man, it's a pretty horrific thought that this lady was convinced that the best thing for her to do would be to croak before her money ran out. That sort of grim perspective is yet another reason why I'm such a big fan of investing in quality dividend stocks. They might not be perfect, and your portfolio of individual single stock tickers will probably underperform the market, but the passive income from your dividend stocks could be integral to simple and solid retirement, and is a strategy which will definitely be more positive than that lady's. And with that, I'll close things off and ask that you do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to do a shout out to my latest Patreon aristocrat, Dad Jokes, who just signed back up for an entire year. Thanks man, I really appreciate it. For everyone else, please consider using my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. I also offer some cool perks you might want on my Patreon page, and consider joining my channel membership on YouTube. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 84 countries around the world. So thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.